This is Paul Jury, the Moses of Finance, certified financial planner, here back with you one more time with another Wednesday Power Shot. So, if you've been following the videos, it's something new that I'm doing every Wednesday. You can mark it on your calendar. I'm going to come at 6 o'clock live. If I'm doing something or something comes up, it's definitely I'm still coming, whether it's recorded or not, to give you some financial and biblical insight. My purpose, the purpose that God has given me as He's coined me the Moses of Finance, to take His people on an exodus from financial bondage to the financial promised land. So that is the ultimate goal. Anytime that I come, I'm looking to give you some practical information that you can apply, give you some education, because the Bible says that my people are destroyed for lack of knowledge. So I feel like when it comes to finance, um, I need to get you as much knowledge as I can, and then try to help you understand it, such to the point that you can then apply it. And that's really where people kind of fall short. And the more knowledge that I give you, the more understanding that I give you, that ultimately builds your confidence. And confidence, when it gets internalized, turns itself into faith. And so that's the ultimate goal. So with that being said, tonight we are talking about investing 101. So I wanted to break down stocks, bonds, mutual funds, index funds, ETFs, which are essentially exchange trade funds, just so that you guys have a working knowledge. And what I will tell you is that if you are not investing right now, you are leaving money on the table. Fam, you have got to be putting some money in the stock market. Now, understand there are certain priorities when it comes to money. You need to make sure that you definitely have your emergency fund funded. You've got to have your debt strategy working. You know, if you're as long as you're at least putting money in a 401k or something of that nature, I think that is phenomenal. But if you, based on what happened last year in the stock market, there are three major stock market indexes. So you have the Dow Jones Industrial Average. I would say don't pay attention to that one. Most people are not aware, even though it's the biggest number, it's the smallest index. It only has 30 stocks in it. So it's not a very good representation of the stock market. The next one is the NASDAQ. The NASDAQ is okay, but it's primarily technology companies, and it is also small companies that are taking on a whole lot of risk. So you may not want to put a lot of your money there unless you're, really a go-getter and you're trying to make, the biggest bang for your buck. But you really want to focus on the S&P 500. The S&P 500 has 500 of the biggest companies in the entire country at this particular point. And all those companies are companies that whether it's Johnson & Johnson, Procter & Gamble, ExxonMobil, Microsoft, NVIDIA, Google, Apple, Amazon, they're all in there, right? But last year, the NASDAQ did almost 50% in one year. The S&P 500 did almost 25%. So it was a phenomenal year last year. And a lot of people look and see that the stock market is going up. And so they're like, yeah, now's the time for me to get into it. When in actuality, the time to really get into it, which most people don't necessarily like, but it's the time when it's bad. So there are strategies that you can apply, but for the sake of tonight's conversation, I wanted to just explain to you briefly why you should be investing, the different types of investments, and how you kind of can structure some of those things. And then I'm gonna get out of your hair. So my focal scripture for tonight is it's a couple. Number one, I wanted to focus on Ecclesiastes 11:2, which is King Solomon essentially writing and saying, invest in 7 ventures, yes, in 8. And then I also wanted to talk about the parable of the talents. So give you Old Testament and New Testament. The parable of the talents is when Jesus is talking, telling a story, and he literally says, there's 3 guys. Hey, I'm going to give this guy 5 talents, 2 talents, another guy, and another guy 1 talent. And from that, these guys have assignments, and then he comes back and takes an account. And so in both of these scenarios, when we're talking about King Solomon talking about investing, and when we're talking about Jesus in his parable, they're both talking about the fact that money is supposed to serve you. You are not supposed to work for money. And based on what they're both saying, that anytime that you have money, You are supposed to send money out. Money is never supposed to be sitting on your couch, sitting in your lazy boy or whatever, with its feet up. Money is supposed to go to work. And so, based on especially the story of the parable of the talents, when money goes out, it is supposed to come back to you with more value, because you never know when God is going to come back and want an account. All right. And so, with that being said, let's talk a little bit about stocks. So, primary reason that you want to invest, period, is so that you can grow your money. It is one of the easiest ways to grow your money. It's another way for you to even double your money. And just kind of a side note, I'm going to be doing a masterclass March 5th on the principle of the double, how you double your income, how you double your net worth, how you double your investments. It's a strategy that I have employed myself. I haven't really talked that much about it, but God brought it back to my remembrance. And it's something that I wanted to basically share with the people that want to hear it. Anyway, so stocks, let's talk about stocks. So you invest in stocks because you want to beat inflation. You want to get a higher rate of return on your money than what you're going to get at the bank. You essentially want to grow your assets. And when you think about investing in stocks, it's you putting your money somewhere. So let's just take 25 bucks. You take 25 bucks and you throw it over there. And you come back and let's say a quarter, and now that 25 bucks is worth 28 bucks, or it's worth 30 bucks, or it's worth 50 bucks. It's doubled. You literally had to do nothing. And all you did was just take some money and just throw it over there. So what is a stock? I like to explain these investments like a shopping mall, right? So when it comes to like a shopping mall, you have a boatload of different stores inside of the shopping mall, right? So let's just say, for instance, you decide that you want to invest in Target. So you go ahead and you invest in Target. So now you basically are part owner. You own shares of this large company called Target. So if Target does well, you do well. If Target does bad, you do bad. Why? Because that's where you have all of your money. You have all of your money in this one particular investment. All right. So you went to the mall and you put basically everything on black or everything on red. All right. So that's essentially what a stock is. Now you can make a ton of money, because last year there was a stock that, and I told my clients that are in my program Exonomics on our last live Q&A. I don't know if it was the last one. It might have been the one before that. But I told them the stocks that took off in the stock market. It was absolutely ridiculous. And there was one stock that particularly took off that went up 243 or 83%. It was absolutely nuts. So if you just put all of your money on that one stock, your money would have doubled twice in a 12-month period. So let's just think about that. That basically means, let's just say you threw $100,000 in there. So now your 100,000 turned into 200,000. Then that 200,000 turned into 400,000. That's essentially how that worked. And that stock is still going up. So, but that's what a stock is. So a stock is going to allow you to cause your money to appreciate in value, but there is risk associated with it, because you're hoping that this company does well. So just as I said earlier, if this company does well, you do well. But if this company does bad, then you do bad. So there are strategies that you should be able to employ when the stock market is doing good. Take some chips off the table. When it's doing bad, if it's a company that's doing well or a company that you believe in, then add more money to it. So while the price is lower, so that when it goes back up, you make more money. People are always concerned about if the stock market is going to, like once it goes down, it's just going to crash and we're going to lose all our money. No, it's not. You're not going to lose all your money. It's not going to happen. And I can prove it to you, because when we were at the start of the pandemic back in March of 2020, we had a day where the stock market was just dropping. And I'm watching my client accounts just drop. And so they literally shut the stock market off. Like there's a switch. Like, you know, you just walk into a room, turn the switch on and off. They turned the stock market off. And that's because those big wigs, that top 1%, that top 15% of wealth earners in our country did not want to keep seeing their wealth dwindle. So the powers that be, they made sure that they told them to shut the stock market off. And then if you look at the stock market in history, every time that it's crashed in history, even though we look at it now like it's crashed, it's come down, it has never crashed back to a previous crash point. What does that mean? That means that when the stock market crashed in 2022, it never crashed, it never came down to the size or to the number that it did in 2020. When it crashed in 2020, it never went down to where it went in 2008. When it crashed in 2008, it didn't go down to where it went in 2000, from 2000, and so on and so forth. So the stock market is like an escalator. It does come down, but it never goes back to a previous crash point. That is something to always remember. So you have to think about our country. And when you invest and think, because we're a capitalist country, it's always more money, more money, more money. We want to get better and better and better. We want to get bigger and bigger and bigger. So if you're investing in that engine is going to keep on moving. All right. And it's really not just our country, it's a lot of other countries. But anyway, that's stocks. Now, bonds. Bonds are supposed to be the safety net, the safe type of investments for what we call a diversified portfolio. When we say a diversified portfolio, we're talking about having more than one investment in your account. And even if you wanted to break it down even further, that's like if you're saying you're having a diversified stock portfolio, that's like putting money in tech stocks, then industrial stocks, healthcare stocks, finance stocks, consumer discretion, utilities, materials. That would be building a diversified stock portfolio. But looking at a bond is something completely different. So the way that bonds work, think of it like this. Your friend comes to you and they say, hey, can I borrow $5,000? And you say, okay, I'll give you the $5,000. You got 10 years to pay it back. While you're holding my money, I need you every year to give me 5% or 2% or 3% or whatever it is. All right. And so their requirement every year is to give you 5% of the 5,000. They don't have to give you the whole 5,000 back, but they're just required to give you the 5%. That's essentially what a bond is. A bond is a company or a state that, like we live in, or a municipality coming to you basically saying, hey, we have a project, we're trying to raise money. If you allow us to borrow some of your money, we'll give you an interest rate on your money for a certain number of years. All right. And so that's essentially what a bond is. It's almost like a CD, a certificate of deposit that you get at the bank. You put your money in, you hold it for a period of time, and you're always going to get a guaranteed interest rate on the money. When the time period is up, you get your principal investment back. That's essentially what a bond is. So a bond is like the safety net for your stock investments, because if the stock market decides to go down, well, then your bonds will generally increase in value so that it absorbs the shock of your stocks dropping. Mutual funds or index funds or exchange trade funds are completely different. What they are, if we go back to this mall analogy, a mutual fund is exactly like a mall. All right. So you think of, like, I'm in Delaware, so we got the Christiana Mall. You got the Mills malls, all those different Potomac Mills, Franklin Mills, all these different malls, right? So if you invest in a mall, it's basically you investing in all of the stores that are inside of that mall. So like earlier, we used the example of Target. If you just buy one share of Target, but instead of you just buying Target, you can buy the entire mall, the entire shopping mall. And then from there, you give yourself more opportunities to make money. Now, you may not make a big, like a huge increase like stocks will do, because your money is so spread out, but you also give yourself the opportunity for more consistent gains. All right. So instead of just investing in Target, it's investing in Nordstrom, it's investing in Macy's, it's investing in Bed Bath & Beyond, it's investing in all these different companies that make up your mall. So your money is diversified. You're putting your eggs in different baskets. You're taking your baskets and you're even putting them on different trucks. And the trucks are traveling different paths, but all the paths and everything lead to your financial goal, which may be retirement, which may be college education, another home, an investment property, whatever it may be. All right. And so when you're investing in index funds are basically mutual funds that make no adjustments internally. See, a mutual fund has a manager inside of it that basically says, oh, this stock is doing well, let me take some profits and put it into this stock because it's not doing so good, so I expect it to go up. Or this stock's doing bad, let me take him out and put another one in. So there's what we call active management. When you get into index funds simply mirror like a stock market index like the Dow Jones or the S&P 500 that we talked about earlier. So either way that you put it, when you're investing in stocks, when you're investing in bonds, or when you're investing in mutual funds, you're going to make more money than your money just sitting at the bank. Now, there's other types of investments, such as in getting into a business, investing in real estate. You can invest in gold. You can invest in alternative investments and all these different types. There's so many, but the basic types of investments that for the everyday person, what you need is a portfolio that starts out with some mutual funds, and then as it grows, you end up adding some stocks that you may be willing to invest in. And then to determine how it should be structured, you definitely want to do what Proverbs 15:22 says, which is seek out an advisor. Proverbs 15:22 says, plans fail for lack of wise counsel, but with many advisors, plans succeed. So you'll want to do that. So if we backtrack back into our scriptures, Ecclesiastes 2, he says, invest in 7 ventures, yes, and 8. So why do you invest in 7? 7 is the number of completion. So you need to have 7 different investments inside of your portfolio for it to be complete. But if you creep over and add an 8th one, now you're getting into the abundance, because 8 is the number of abundance, infinity, the new beginning, right? And then when you look at the parable of the talents in Matthew 25, you see that these 3 gentlemen, were actually really 2 gentlemen, ended up getting their money. They did something with it, doubled it, and brought it back. All right. So God talks about investing in the Old Testament, and he talks about it in the New Testament. Why? Because your money is never supposed to be sitting idle. Your money is supposed to go out, gain more value, and come back with more value than you sent it out. So this is why you should invest. So if you are not investing right now, I encourage you to invest, because this year in the stock market, just a little bit of financial advisor insight, this year in the stock market is not going to be too bad. All right. Don't worry about the ups and downs. If you're not investing, you're leaving money on the table. So, ladies and gentlemen, I went 17 minutes instead of 15. But as always, I pray that this blessed your life. I pray that I said something or gave you some type of information that maybe motivated you, gave you some faith to go ahead and open that investment account, go ahead and start investing and make yourself some additional money and grow your net worth. Also, be on the lookout for some content from me in terms of my next masterclass, which is going to be on March 5th at 7 p.m. I am going to be talking about the principle of the double. I'm going to be talking about how you can structure yourself to be doubled by God, how you can double your income, double your investments, and double your net worth. This year, 2024, is the year for you to be doubled. Catch y'all down the road.